right, let's go ahead and just get started. I want to keep this, within the hour, of course, and I also want to leave plenty of time for questions because we have a couple of major announcements for investors that we want to cover through this call, and I'm sure that's a major reason why we're on the call. If you don't know me, this is a little bit about me. I'm a former Army officer. Actually, I'm still in the Army, in the reserves, and I enjoy serving in general. I also enjoy teaching. And yeah, Trophy Point's been my pet project for the last few years after I've sold my other real estate assets. So here's the kind of the upfront. To date, over the last 4 years, Trophy Point's originated $176 million worth of loans. And that number just keeps growing and growing every month. We're lending about 5 to 10 million a month. But as I say, any idiot can send money out the door. It's getting paid back. That's the real test, the real gauge of how good a private lender is. And so I'm happy to report that we've got 100 million paid back on all of our loans with no real major issues. Yeah, we've had a couple foreclosures. Yeah, we've had a couple defaults, but we've never lost money actually on any of the loans as far as principal goes. And then, we've had more repeat borrowers, which is fantastic for our business. So it says a lot about our customer service and why people want to do business with us. I'm always here to help anytime. This slide has been on our webinars for the last few quarters, but I always keep it up there because I pride myself on making myself available for real estate questions, especially, or any problems for that matter, to friends and investors and prospects. So Mike Martin, in this case, was a West Point grad. He was looking at doing an apartment deal. He ran it by me. I pointed out some things, and it turned out I saved him a few $100,000 in despair because it turns out the seller of his apartment building was trying to screw him over by maintaining that some repairs were done, but they were not actually done accordance with permits and stuff like that. So if you don't know, we have a few names that I don't recognize on this webinar. So I'm going to just briefly discuss what we do. For most of the people on the call, you already know what we do. So anyway, we're a private lender. We're like a private bank in many ways. Like I take your money, give you 8 to 10 to 12% on it. Then we lend it out at higher rates to folks that are trying to flip houses or buy commercial real estate, mostly residential, actually. We only lend on residential type assets. We take a first position lien. So we're always secured. And we typically focus on the military affiliated community in terms of borrowers because they're a great niche to work with. Really one of the major reasons why we haven't had any losses on the loans that we've made out of the 176 million that we've sent out the door. And then probably more important than that is I'm personally invested significantly. Between me, Dave, and Nick, we've got 8 million. Actually, it's more than that, but we've got at least 8 million of our own dollars in the fund, and we take the first loss on any bad deal or bad decision that we make. And I don't think you'll find that with any other fund. I feel very strongly in aligning risk with what we do and the investors that we have. I don't think you want to be in bed with a manager that just slings your money around, hoping to achieve the highest yields, but then not pay attention to the risk. In our business, we focus more on the risk. And what I tell the team is that we manage the risk, not the return. And our personal $8 million that we've invested is a testament to us putting where our money where our mouth is. So you have a lot of options when it comes to like yields and stuff like that. And these numbers have been updated as of September in terms of what you can earn from public asset classes. So through September, at least, REITs returned about 5%. Treasuries earn on average around 4.1. Stocks, the dividends that you get from stocks is around 3.8. And then any emerging debt and any emerging market debt that you could get at B or A graded above 2.7, and Trophy Point offers 8 to 12. And so we offer pretty good equity-like returns without the stress of the volatility or the variance. And I don't mean this as a sales pitch, rather than we've performed. We've sent 17 straight quarters, about to be 18 straight quarters of interest payments at the 8, 10, and 12% yields, and we haven't missed anything. We haven't missed a payment or not paid anyone throughout that entire time. Here's our rates if you're interested in investing. The rates are 8, 10, and 12. We are getting rid of the 12%, or at least suspending it after the 31st of January. So I believe all the investors that are the 200 plus investors that we have with Trophy Point right now have received this message. But if you're new and you are interested in earning 12%, it does require a minimum investment of $1 million. But given where interest rates are going, the Fed has reduced interest rates by 75 basis points over the last 2 rate cuts, or last 2 months. This industry is also becoming very popular with Wall Street. Hundreds of millions of dollars are entering our space every month. and it's resulting in competition and lower costs for borrowers and stuff like that. And so we were lending out at 11-12% just interest, not including the points. Now we're seeing pressure to go down in the tens. And so we've got to make some decisions on suspending our higher rate offerings. We will obviously keep the 8 and 10. I don't think that's ever going to go away, frankly, but we are going to suspend the 12% annualized after the 31st. So you have until now, until the 31st of January to get to $1 million and earn 12% on that money. But any new money after the 31st of January will fall into the 8 and 10% buckets, depending on how much money you put in or whatever your current balance is. So that's a pretty big announcement, I would say. So if you've got questions or comments or want to make a comment about it, there's a chat and Q&A buttons at the bottom of your webinar panel, your Zoom panel. So feel free to use those tools to get your questions answered. When it comes to retirements, I think we're a great option for retirements. The rates for retirements have not changed, except the 12%, which will go away, like I mentioned before. But for retirements, 10 and 10.5% still exists and will always probably exist for the foreseeable future when it comes to the yield offerings that we have. We like the retirement accounts because the likelihood of an investor redeeming on something that earns 10% is very low. And I also think that, and I have money tied up in retirement as well that earns 10%. Like, I think that yield is excellent for compounding your retirement dollars in a low risk manner. We do offer a referral program now. For those of you that are existing investors that wish to refer, we have an incentive of $1,500. This was something you suggested as a result of our survey that we put out a few months ago. So we listened and we've come out with a referral program. So if you want to take advantage of that, all you got to do is make a group text with that phone number and the referral, whoever that person is, and then we'll take it from there. And after they invest, we'll deposit the $1,500. Some of you had suggested in the survey to make it percentage based. And we thought about it, but then we realized that there's a privacy problem if we make it percentage based, because we don't share, first of all, we don't share who our investors are with anybody. Second, if you were to get a percentage based referral on what someone else invested, and let's say you're getting 1% and you get $1,000 check, well, then you'll know that person invested $100,000. And so we wanted to step aside from that sort of discussion on telling you who your what your referral invested inside Trophy Point for the sake of privacy. So we just kept it as a flat rate of $1,500, which we hope is compelling for you. And it's your choice. You can add it to your investment account, or we can send it to you in cash, or I can donate it on your behalf to a charity of your choice as well. So let's get into the meat of today, which is wrapping up the year. I'm very proud of what we've accomplished this year. So you can kind of see the trend, 2021, 2022, 2023. These are the first, these are the full years that we've been in business. And what we've seen in 2024 is just higher consistent loan volume. Nearly every quarter this year, and maybe even December, we're at 10 million right now for the quarter. December's not done yet. We have about 4 or 5 million of loans left in the pipeline. If they all close, then we'll be another $15 million quarter. We've hit 18, 19 million quarters for 2024, whereas in 2023 we're 13, 14, 15. So we're consistently ahead every quarter, which is what I'd like to see, because this is a hard business in terms of cash flow prediction. People come to us on a short-term basis because they need to close loans in 10, 12, 15 days. And we haven't done any marketing actually in terms of like trying to find borrowers. And that's going to start in 2025. But the consistency is what matters to us. And that says a lot about the repeat borrowers that we have. And you may have remembered from a previous slide, we've got about 60% of repeat borrowers, which is fantastic for a business like ours. It also helps on the underwriting because we also get to know our borrowers better. A closer working relationship typically is better when it comes to avoiding defaults and avoiding non-payment of our loans. And then, more important, like I said, we're also getting paid back on a lot of loans as consistently as well. And what the takeaway from this is, not only do we have good underwriting to generate these types of payoffs, but also I think it's a barometer of what's going on in the general market. Like any real estate business, and frankly, any business in America, we're dependent on the credit markets. we're dependent on banks lending. We're dependent on liquidity, in the market in general, because our future buyers, the people that buy the homes from our borrowers who flip a house or who upgrade a house, they're getting bank loans. They need to get a bank loan or a mortgage, typical conventional mortgage, in order to buy the collateral that our borrower has borrowed on, and then ultimately to pay us back as well. And so it's kind of funny, but in the month of September, we actually got more payoffs than we actually lent out, which is fine. We're not like alarmed by it. If it happened in multiple months or multiple quarters, then we'd have to seriously look at what we're doing to generate loan volume. But that hasn't happened yet. Each quarter, almost, we receive $13 to $14 million back every month. This quarter, rather, we're $8.5 million so far, and I know we've got about $2-3 million in payoffs coming in the door over the next couple of weeks. So we're very happy about payoffs and stuff like that. And the payoffs are good for you too as an investor, because we've had investors redeem. We have 200 current investors, and we've had probably 225 total investors come in, and 25 have redeemed at any point over the last 4 years. We're happy making our 90-day redemption notices. We're happy making that assertion because of the liquidity and of the payoffs that we get every month and every quarter. And here's our geography. So the blue dots represent paid off loans, and the red dots represent active loans. And as you may remember, I said we're kind of a military affiliated borrower. These dots coincide very strongly with military installations, US military installations. It's kind of like why you see these dots in the random parts of Texas or Tucson or south of Tucson, Iowa, Missouri, Oklahoma, Colorado Springs. There's an Air Force base outside Boise. Fort Lewis is outside, just south of Seattle in Tacoma, Washington. The Great Lakes Naval Training Center is north of Chicago. Fort Drum, which is outside Buffalo, basically New York, or near Buffalo, New York. Lots of military bases in Georgia, South Carolina, North Carolina. Anyway, these are all like great markets, because military markets experience a lot of people coming in and out. And that velocity is very important when it comes to, discovering real estate prices and then also understanding the stability of real estate prices. You don't want to be in lending, at least. You don't want to be in like the Dakotas or Montanas or Wyomings, because they don't have areas with more than 50,000 people. And that's not enough trades happening to ensure that there's comparables in which to judge or estimate the price of what your asset is, which is really important in real estate lending, and in single family real estate lending, I should say. The other important call out from this is that our average loan is around $207,000, which is what I'd like to see, because we've got about 74 million right now outstanding in the current portfolio across 312 loans. And what that should tell you, what it tells me, is that we've got adequate diversity and diversification across the loans. Not even 10, 20 loans going south on us, i.e. not paying us monthly interest, would hurt the fund in any material sense. It may hurt me personally because I've got $8 million tied up and I take the first loss if we go to foreclosure, and the foreclosure results in getting less money back than what we lent on. But, across 300 loans, a lot of things would have to go wrong for me to get wiped out of my 8 million. And then for you as the investor to be touched or affected by all this as a subsequent effect. So that's good. And as you know, your dollar is tied to the entire portfolio, not to the performance of any individual loan. And then, of course, as you can see, it's kind of obvious, but by the dots, we're very geographically diverse as well. And you can see also by the red and blue dots that we're also in markets that we know really well. Like almost every market that we're in, every red dot that we're in also has a blue dot corresponding to it, meaning that we've lent and been paid back in that particular market, which is fantastic when it comes to, we want to know our markets, obviously. Looks like we have a chat. Let me go to that. So there's a question. Any idea what's behind the lower November loan volume and possibly going forward? I think what you mean by the current quarter, Brad. I think it's two things. One, it could be seasonality. Two, I also think it's greater competition. I think, like I said before, hundreds of millions of dollars of new money is entering the private lending, real estate lending space. And that's putting pressure down on rates. And there's more lenders than there were today than there were at the beginning of the year, because this is a great space to be in. Thankfully, Trophy Point has built a name for itself, and we've got market share and things like that. So we have like a more permanent footing. That's the reason why we're reducing the 12% or suspending the 12% offering, is that competition is heating up, and we are seeing it, to your point, I guess, in your question, is that numbers are going down or lending is going down in that regard. Good question. So in terms of investor earnings, I stand corrected. We have 211 investors. That's great. We've sent out $6.2 million out the door to our investors this year, which I'm very proud of. We've got 200 plus investors, which is fantastic. And we've grown. At the beginning of the year, we were around 52 million in AUM, and we've raised about 24 million since then. So we're at 74. So we grew like almost 50% in terms of size in 2024. And then for the year, we'll probably hit 72 million by the end of the year. But so far, we've originated 67.5, paid back on 52 million as well, which is fantastic. And you can see the number of loans that originated and been paid back. I'll just talk about last year briefly. Last year, we had originated about 58 million and gotten paid back on around 40 million. And we had originated 300 loans all of last year. Now I think we'll probably hit 325, 340 maybe by the end of the year, based on what I see in the pipeline. We are definitely growing, and our job really is not, like, I don't see this as a game if I got to increase assets under management for the sake of it. I don't get paid any more in terms of management fees or anything like that just because our AUM grows. Like, we have no incentive to grow AUM, frankly. Unlike other funds that have an incentive to just collect as many dollars as they can because their management fee depends on it. Well, in my case, I don't pay a management fee to myself or my partners. We don't collect one. So AUM is somewhat meaningless to us in the sense that, like, it doesn't really affect our personal compensation if that's something you're thinking about. What it does matter, though, is our reach and our ability to do more loans and to keep paying the interest that we currently have. That's important. And I'm happy to say that we don't see any major roadblocks or major issues going into 2025 on that. We haven't had many redemptions this year. I think I can count on my hand the number of redemptions that we've had. We've had another question. Let's see here. So Donald asks, do you see any differences in business model with the change in administration in Washington? Will the housing market be affected? I think it's too early to tell, frankly. Like, in my quarterly letter that I'm drafting, I'd spend pages and pages on thinking about all the various ways this could go. And frankly, I don't know where this is going to go. I think the administration is going to put a lot of pressure on the Federal Reserve to reduce rates, to continue to reduce rates. I don't think the Federal Reserve is going to increase rates by any means. And if the administration succeeds, the new administration succeeds in influencing the Federal Reserve to reduce rates, then I think it'll be a great thing for the housing market. I think lower interest rates will mean more people can afford housing as a result of lower interest payments, monthly interest payments. And that actually helps us because that means that there's more Americans that can afford the collateral or the houses that our flippers, that our people are having, that are trying to sell an upgraded house. Or it means that they can refinance better with better terms if the borrower had a rent to hold strategy as well. In fact, I'm glad you asked that, Donald, because I have a poll that I'll probably launch right now. So I've just started a poll. And the question is how do you feel about 2025? And the answer choices are bullish, bearish, or undecided. So please, please interact and make a choice. We'll leave the poll up for a few more seconds. I really should have taken the undecided away. You really got to take a position, but we'll allow it, and I'll share the results. So it looks like we're kind of split. Thankfully, I'm happy to see no one thinks it's bearish. That's great. Half people think it's bullish, and half are undecided. And I put myself in the camp of more bullish than undecided. I think we have more great things going for us than we do against. But at the end of the day, like, what kills, or not kills, but what hurts American capitalistic systems are the shocks that you don't know about. We have gotten so great as an economy with data and crunching numbers and analysis that it's not the things that we know about that's going to hurt us. It's the things that we don't know about that always hurt us, which I don't have the ability to predict. If I did, I wouldn't probably be in this business. I'd be doing something else, most likely, if I could predict the future. But what I can offer is that if you're making investment decisions, you want to have a defensive sort of posture. And I think, like, what we do defensively speaking plays to that. Like, we've got geographic diversity. We've got hundreds of loans out there. So there's deal diversity, so to speak. we're secured so that like, real estate assets will never go to zero. I think you want to answer those questions about any investment that you may be thinking about into 2025. But Donald, to your point, we are rate dependent. I think rates will head in the right in a more favorable direction than not. So let's talk about sales prices. And this is like really important for us because we obviously care of what houses are selling for in America because we need to gauge if people can afford it. And if housing affordability is a big issue for America. And I'll tell you how we utilize this information. So it shouldn't come as a surprise to most people that housing is going up. The average median home price right now is around 430, 435. And frankly, at 6%, 7% interest rates, that prices out a lot of people for buying a house. And on top of that, we're already short 3 to 5 million housing units short, depending on how you look at it or who you believe. The way Trophy Point handles this information is that I want to have loan amounts that are lower than the median sales price. Meaning that if I had to take over a property and I had to sell it to liquidate it to get our money back, it's a lot easier for us to recoup a $250,000 security or asset than it is to sell a $400,000, $500,000, or God forbid, like a $700,000, $800,000 house. Because the number of Americans that can afford a $400,000, $500K house are small. But the number of Americans that can afford a $200,000, $250K house, and I'm talking liquidation value here, are a lot more than that. So I always want to lend in a manner that's below the median, well below the median sale price in order to be defensible, to get houses out the door, to sell off a house if we had to. The next measure is the number of days on market that a house stays on market. So it's interesting, and this is largely driven by, in my opinion, the housing shortage. But before COVID, it wasn't uncommon for houses to stay on the market roughly between 40 and 80 days, 40 and 60 days to sell. Heading into 21, 22, 23, that was, homes just were snapped up quickly. But then you may remember in mid 2022, interest rates started dramatically spiking, 75, 50 rate basis of increase per increase even, right? So we went from 0 to 5.5% federal funds rates in the span of 6 months, 9 months in 2022 to 2023. And that resulted in interest rates increasing dramatically for borrowers on conventional mortgages. And so that's where you see this spike of going 20 to 45, 50 days, 30 extra days longer on the market. And that started coming down, and then it's going up again, it's coming down. So anyway, it takes about 40 days to sell a home right now, which is still better than what homeowners experienced the first part of the century, really. And that's good for us because we want to be in a lending environment where, again, if we had to foreclose or our borrowers had to sell quicker than they wanted to, homes are still going off the market in a decent period of time. I would be worried if homes were staying on the market average 80, 90, 100 days. That's pretty excessive for what we do because of the high interest rate we charge our borrowers. But taking 30 to 45 days, 60 days maybe to sell a house is good. And it represents a reasonable holding cost or holding period for our borrowers. Another metric, right? Average sale to list percentage, meaning that if you sold a home for 100, if you listed a home for 100 cents on the dollar, what did you ultimately sell it for? Right? And so right now, it seems that homes are selling for roughly 99% of list. We're not seeing a dramatic decrease in list prices, which means that, it suggests to me that homes are not selling at exuberant rates or exuberant prices. Now, you could point to the housing shortage because of this as a main reason, and you're probably correct. But compare that to pre-COVID, where homes were selling at, in many cases, I would say significant, 4% in my case, below list. That's not good. But when homes are selling at 98 to 100% of the list price, that means that the sellers aren't exuberant, the buyers are willing to buy at that price. And it also helps us with our comparables analysis because we use comps to value the properties that we're lending on. So anyway, it's a good story that right now the sale to list percentage is stable. If it drops below 97, 95, 96%, that's when I would start to get concerned and we would pay even closer attention to what we lend on. And again, the challenge about these stats is if I had all the time in the world, I would give it to you by market or by region at least. And maybe we'll do that in a future update. This is what's going on nationally. So the inflation rate is being won largely. It's being won, and I say that in the active tense. I don't say that in the past tense. There's still a bit of ways to go to get inflation under control. And frankly, I don't really believe in the headline rate, which is this 2.6%. Inflation shows up in other ways, and it affects segments of the economy differently. For high earners that make six figures, inflation does affect them, but affects them differently than like the family that's making only 50, 60K, right? Groceries for that family are more expensive, right? And that affects them differently, and affordability matters. And so we care about getting into assets, lending on assets where I would say it's affordable, right? Affordable to the most number of people for the sake of liquidity of selling off that asset. I don't know what the administration is going to do. If inflation creeps up, the president has signaled that he could fire the Federal Reserve Chairman. I don't think he can, actually, which I think is a good thing. I think they should be separated. The president does have the ability to nominate, which is his right, but I don't think the president has the ability to fire the Federal Reserve Chairman. But I do think the president has the ability to influence the Federal Reserve to reduce rates. But I think that would be a hard argument if we see inflation increasing for where it is. The recent job numbers, point to the idea that the economy is still robust and strong, and that may be a reason to increase rates if the job numbers are still strong. But I also think, like, in a weird way, that you can't believe the numbers that you hear, because you may remember a month ago or a couple months ago, the Federal Reserve had to revise the job numbers. They had said that the Q2 job numbers had risen by 200,000, but then the revised number said that, well, no, only 100,000 jobs were created or something like that. And they had to cut the original report by 50% after the fact. So when those sorts of things happen, I just have a hard time completely believing in the numbers. But I will say this, the trends are heading in the right direction in terms of lower rates. So what's next for 2025? And I'll wrap this up, and I want to leave plenty of time for questions and things like that. We are suspending the 12% rate for 2025 after January 31st, 2025. And I said that because we're doing that because there's more competition. Rates are coming down for our borrowers. And so we've got to compete in terms of the overall cost of capital that I have for the fund. So you have, basically 45, 60 days to achieve the $1 million threshold to earn 12%. If you are an existing investor that's earning 12%, you're going to be grandfathered in, and your investment rate will not change. We won't change that on you. But new dollars that you want to add after the 31st of January would go into the 10% bucket. So now is the time to add to your account if you want. Investor portal. So, the survey, one of the highlights of the survey that we sent out was a portal, or the request for a portal. And we expect to release that in the first quarter of 2025. And with the portal, you'll get the ability to just pull all your documents and your statements from one login, and it'll save you the trouble of emailing me or Danielle, even though we'd love to hear from you. It would save you the trouble of getting all that information. And more importantly, you're going to get your 1099 in the first month of January as well. And so we hope this portal will allow you to get your 1099 quickly. And, you can access it afterward as well. I'll tell you this, I only get 1099 requests 2 times a year. I get it. We get 1099 requests April 14th, right? The day before the taxes are due. I always see a spike in those requests, and we always get the 1099s back to you again by April 14th if you really need it again. And then I always see them October 14th. I always see the requests for 1099s a couple days before the tax deadlines. And we're happy to always accommodate and get you those 1099s. But with the portal, I think you'll be able to pull it at your discretion without the flurry of text messages to me and Danielle. So I thought I'd kind of give you an update on where we're headed. Trophy Point's experienced 3 sort of evolutions over the last few years. Trophy Point 1.0, there was nobody. It was just me, Nick, and Dave. There's no employees. Everything was done manually, no automation. 2.0, we started building some back office systems. We got some software introduced. We got a line of credit, which is great. We started expanding the team. We started hiring folks. I'll tell you, in Trophy Point 1.0, Nick and Dave had day jobs back then, and they were closing loans in the bathrooms of their day jobs or in the parking lots of their day jobs. But in Trophy Point 2.0, they both decided to do this full time with me. And now we're not closing loans in the back of a closet. We now have office space. Now we have a team. We have all these other built out systems. And then in 3.0 onward, we've gotten more lines of credit, which is great for our liquidity and being able to close even more loans in a quick amount of time. The way we use lines of credit is we use a line of credit to close loans quickly, and then we backfill with investors that come in and we pay down that line. So we don't really, like to sit on our lines drawn too much or for too long. And we've built out the team. Right now, we have about 20 team members actually part of the Trophy Point team, which is great. Now, most of them are foreign, overseas in the Philippines, which is part of our strategy because it's a lower cost labor strategy. And I talk about a lot of this in our quarterly letters. But we're happy about the overseas team because they're really good at procedural based work, which is what closing a loan largely is. And it's very checklist oriented. You'll also see more systematic capital, or in other words, more advertisements and more public outreach on behalf of Trophy Point to raise money. I'm always a believer that if you manage a fund, you should always be raising money because you just don't know what opportunities are coming down the pike, assuming that the market is favorable, which it is. And I think it will be for the foreseeable future. So we're always going to be systematically raising capital and stuff like that. So I hope you enjoyed our update. I wanted to keep this on the shorter side because I wanted to leave time for questions and discussion from the audience on what we've accomplished in 2024, where we're headed in 2025. And if you have feedback on our 12% program, I'd love to hear it. The floor is yours. Paul asks, are most customers flippers? And if so, is that market still healthy? So, Paul, what I would say is we're seeing more people that are buy and hold and refinance than flippers over this past 2 quarters. In the beginning stages, we were really optimized for the flippers, and that business still exists, actually. But it's also regional based. So the loans that we have in Ohio, Indiana, Missouri, Tennessee, those are still flipping markets, and they're pretty healthy because people are still moving to those areas, and the price points make it worth it for flips. You can still find houses at the 75, 90K, 100K, 200K level for a flip. But outside Virginia, for example, where homes are a little bit more expensive, those tactics that the borrowers play are more buy, hold, and rent. Good question. Rob has a question. What does the pipeline look for new loans in Q1? Great question. So right now, our pipeline, I'll just show you guys, actually. Might as well just show it to you so you can see how the sausage is made. So, the good news is we have software that now helps us move loan files through the system. So right now we've got $13 million across 48 loans at some point in the pipeline, right? Now I'll say that, we've got about $2 million in loans that are clear to close. And you can kind of see the amounts in the files here. We've got about $1 million in final review. That's 6 loans. And then we've got a handful more loans in some stage of underwriting, right? They owe us some documentation, or, they require, some sort of additional underwriting, that sort of thing. That's the way we do stuff. So 13 million is to answer your question. Thanks, Rob. Okay. All right. Any concerns about growing too fast? Ted, that's a great concern I have is we're not growing too fast in the sense that we don't advertise. We're not actively seeking folks to borrow from us. We don't, in fact, I'm a little ashamed to say this. I don't even have an email list of all of our borrowers in one place. It would take me about an hour to go through my email and through our mortgage automator system to even gather an email list of our borrowers. And that should tell you the state of our marketing when it comes to borrowers. So everything that we've done so far has been kind of organic and sort of, I guess, natural that comes our way. We do want to grow because, like I said, competition is heating up. And so I'm not concerned about growing too fast. I think we may be not growing enough now that hundreds of millions of dollars are coming into our space every month. But like I said, you may have heard me say this before, I'm not going to risk money I have for money I don't need. Because I carry the first loss, I'm not interested in taking on risks just to earn, 3-4% of origination fees on on money I don't frankly need. So we really don't want to grow for the sake of growing, but we do have a healthy base, and I do believe we can do a lot of good, and I do think we can make some money sensibly. But I don't think we're growing too fast. Now, Dave and Nick may have a different answer for you, to argue against myself for a moment. From a numbers perspective, I don't think we're growing too fast. But from an operations perspective, we may be growing a little faster than Dave and Nick would like, because we are such a high touch type of lender. Our borrowers usually can get us on the phone within the first or second ring. We always answer emails. We try to answer emails within 24 hours. And now we're managing a book of business, a book of loans of 312 loans on our portfolio. That does produce strain on the team when you've got 300 loans and 300 borrowers, each with their own sort of unique needs sometimes. They may say we've grown a little too fast, but I don't think it's a problem, because we've added more headcount over the last 3-6 months anyway to alleviate that problem. But we'll see heading into quarter one, and I'll keep you updated on with our quarterly letters on what that looks like. But great question, Ted. Thanks for the question. Feel free to pose any more questions. The chat's open, the Q&A button's open. Well, I'd like to say I hope you guys have a great holiday season. I sure am. We just had a baby. If you didn't know this, we had a baby a few months ago. I'm excited about hanging out with him for the holidays. His name is Sher, which means lion in Hindi. And so this is my first holiday as like a family man, I guess. You know, before, it's my wife and I have been married for 8 years. So this is like our first Christmas as a family with a little one in tow. Well, hey, look, I'm only a phone call away. My phone number is right there. Call me, text me. My email is right there. I'm only a phone call away if you have any questions or wanted to discuss anything. And I wish you the best holiday season you can have. Take care, everyone. Merry Christmas.